X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, the worst of both worlds, inflation ticking higher while economic growth seeing a major slowdown. Invesco Global strategist Brian Levitt says, take a deep breath. He's not worried. Then it's Woodstock for Capitalists, Berkshire Hathaway's annual meeting happening in Omaha next weekend. Our resident Buffettologist, Andrew Barry, will tell us what to watch for at the event as shareholders eye Warren Buffett's succession plan. And later, Jack Howe's twist on a hot investing trend. But we begin, as always, with our expert panel and 3 things investors should be thinking about right now. On the Barron's Roundtable, my colleagues Jack Howe, Andrew Barry, and Megan Leonard. So, Jack, I'll start with you. After some down weeks, we finally saw an uptick in stocks this week, which wasn't bad, on earnings mostly.
It was a little wobbly there for a while. We got soft GDP, we got elevated inflation. Finance nerds across Midtown Manhattan began beating their chest and crying, stagflation. It's not stagflation. It's fine. The consumer spending, remains strong. Inflation's a little stubborn, but the economy is coping. Companies in the S&P 500 are beating earnings. They always beat earnings estimates by a little more than usual, though. That's a good sign. First quarter growth, that's trending toward 5% plus. The full year estimate is still 10% earnings growth. We'll see. We'll see if those estimates come down as we get further on in the year. But it was good to see good numbers from Microsoft and Alphabet. That keeps that artificial intelligence narrative going for at least another quarter, so that's helpful. I think if investors seem nervous about maybe some of the economic data points, it's because the market's pretty pricey, 20 times earnings. Things need to be perfect.
But it is nice to see investors looking at earnings instead of just what the government's doing. Okay, what are you looking ahead at next week? I think we're only about halfway through earnings season. Who's going to just beat by just enough to make the street happy?
Well, next week we're going to see, we're going to get results from Amazon and Apple in tech. We're going to get Hershey and Coke in food, and we're going to get Eli Lilly for drugs.
All righty. So, Megan, this higher for longer narrative that Jack said might have upset stocks a little bit, it certainly upsets people who want to buy a house. What's happening in the housing market?
Yeah, so we've actually seen mortgage rates expand substantially since March. So they've risen to nearly 7.2% over the past week, according to Freddie Mac. And unfortunately, the 10-year Treasury yield suggests that more unpleasantness is along for the ride. Now, of course, that's putting, as you pointed out, pressure on home buying. But it's interesting because it's not showing up in the data quite yet. So the National Association of Realtors said the pending sales for March was actually up 3.4%. And it's actually the Northeast that's leading the pack for once. So good news for all of us New Yorkers, followed by the South and the West. So hottest markets right now are definitely in that New York area, in the New England, and even places like North Carolina. So kind of an interesting trend here going on.
Which is funny because back in the housing crisis, before the housing crisis, we said, oh, it's all about regional. There's no such thing as a national housing market. Then we're like, oh, yeah, there's a national housing market. And now we're going back to the old normal where you can see some divergence. What's the toughest place to buy a home right now?
It's interesting. My colleague Shayna was really looking into this recently, and she said that it's interesting. Those places that were doing well during the pandemic, because they saw such reversions from the historical norms, are those that are most vulnerable. Places like Florida and Texas are actually seeing a little bit of easing, some stagnation in prices for sure. And a lot of it actually has to do with supply. A lot of this story is actually not necessarily about rates. It's about our housing supply. And so as that gets back online in some areas, you're going to see regional differences really start to sprout up.
Low supply, high demand, inflation. Okay, I hope we can build more houses. Andrew, meanwhile, Tesla has had a terrible year, but after a terrible earnings report, the stock actually popped a little bit. Has Tesla hit bottom?
Well, the earnings were weak, but they weren't a disaster, and the stock had been so weak that it was a bit of a relief rally this week in Tesla. And the key thing that encouraged investors was that Tesla appears to be accelerating the introduction of a lower-end car to the first half of 2025, about 6 months earlier than expected. But there's still a lot of problems now for the electric vehicle market. Sales growth is slowing down globally. They're up about 7%. In the first quarter, that's down from about 20% in the fourth quarter of last year. And Americans, now that all the early adopters have bought them, don't seem to be all that enthusiastic about electric vehicles, despite all the efforts of the Biden administration to get people to buy them, including these tax credits of about $7,500 per car.
If a low-end car is the bull case, I don't get it, because low-end probably means low margin. The other thing I hear about is the robo-car future. That's 10 years away at least, and for people who are calculating a present value for future cash flows, 10 years away is known as never. It doesn't matter. So I don't really understand the bull case on the stock at this point.
What do you think, Andrew? You like the stock?
I think Musk thinks the robotaxis and autonomous is going to happen sooner, but I think there's a lot of skepticism on Wall Street about that. The stock is still very expensive right now. It's around $170 a share, which is about 80 to 90 times this year's earnings. Growth is slowing, and rival car makers trade for around 10 times earnings or less, including what's now the industry leader, Toyota, which is stealing some of Tesla's thunder with its success in hybrids.
Hybrids are sexy.
And the Chinese electric car maker, much lower multiple than Tesla, and they're selling more cars.
Yeah, I mean, BYD's coming after them, and that BYD could be in this country in a couple of years with their EVs.
Right, and then Elon Musk tweeted just on Friday, a meme said, equating people who believe in climate change with communists, probably not a great way to appeal to potential electric car buyers. Anyway, inflation, meanwhile, hotter than expected, while economic growth sank below forecasts. Invesco global market strategist Brian Levitt on how investors can best position themselves. Next. New data out this week giving a fresh look at the health of the economy. The Fed's favorite inflation gauge slightly higher than expected at 2.7% annually. Month over month, inflation remained flat at 0.3%. The economy also growing much slower than expected in the first quarter at 1.6%. That's below the 2.4% estimate and drastically down from the fourth quarter's nearly 3.5%. Joining me now is Invesco global market strategist Brian Levitt. Brian, great to have you back.
Great to be here. Thank you.
So higher inflation, lower growth, not an auspicious combo. Should we use the stagflation word?
I wouldn't call it stagflation.
Okay.
So it's certainly not stag. This is an economy that is still doing well. If you look beneath the surface of that GDP number, a lot of it was imports took away from growth, and you had some slowdown in business investment. The consumer did fine. Now, inflation, we could debate, right? And yeah, the numbers are still a little bit hotter. It's not broad. There's some components driving it, and it's a little bit higher. But I would still come back to the fact that good nominal growth, which of course includes inflation, is not necessarily the worst place to be for investors.
Can you just explain that dynamic briefly? So if the country imports more, that actually subtracts from the GDP print?
Well, we have we all probably remember the first day of our economics classes when they told us GDP equals C plus I plus G plus NX. So net exports, yeah, of course, exports minus imports. So the consumer's been importing, so it's a bit of a drag on it. But again, the consumers held in nicely.
It's always dangerous to cherry pick this data point and that data point, but I do want to cherry pick nonetheless. In the inflation print, a very large part of that is something called owner equivalent rent.
Right.
Can you explain that and how that can possibly distort inflation numbers?
Yeah, so owner's equivalent rent is basically what would it cost you to rent your home.
But that's a guess.
That's a guess. Nobody's actually paying it, right? We all have mortgages and whatever expenses and fees we have. So it's a guess, and it tends to lag what's actually happening in the real world. I like to look at Zillow will put out a number, S&P Core Logic will put out a number, and this is what it costs to rent home prices. Year over year, those peaked over a year ago. The owner's equivalent rent is peaked, but remain pretty elevated. So it's slow to come down. It usually lags. A lot of people, and myself included, suspect that's what's keeping some of the CPI services sticky.
Now, investors, and we in the media are guilty of this as anybody, are always looking to, will the Fed cut, in May?
Yeah.
Will it be July? Will it be September? And really, for the longer-term investor, it's not that important. What are you watching? What are you telling investors to be aware of?
It's not. This is like the new pastime, right? We used to go to baseball games. Now we go to parlors and debate what the Fed's going to do.
You can bet on it.
Yeah, the beginning of the year, the market thought 6 rate cuts. Now you're down to maybe 1 or 2 embedded in the market's expectations. I don't really care too much. I'm thrilled that the tightening cycle's over. We didn't enjoy that in 2022. I'm thrilled it's over. The Fed will ultimately ease. It's just a matter of when we get there. So for the intermediate term investors, my view has been, and it's worked nicely so far, peak inflation, which happened in June 2022, peak tightening, which happened in July 23, peak rates, all tends to be good for the stock market over the subsequent years. Doesn't mean every day, but over the subsequent years. And so far, that's been playing out quite nicely.
One more investing question for you. So we've long said on this show that one should separate political beliefs from your investments, right? Political is very emotional. That's not the way to treat investments. But you actually put a chart and numbers on this, and I was actually blown away. I mean, I agreed with you. I didn't know how much I agreed with you.
Yeah, the magnitude of it's pretty significant.
Can you break that down for us?
So the magnitude of it is significant. What I did was I found an index that goes back as far as I can. That's the Dow Jones Industrial Average Price, not total return, back to 1896. I believe Grover Cleveland was president. I say you put $10,000 and you hold it for the whole time, it climbs to over 10 million. Then I said, what if I came out of the market and went to cash every time a Democrat was in office or every time a Republican was in office, and your results are your 10,000 climbs to a few 100,000.
Wow.
Right. So much further below the 10 million. And you think about it, if you didn't invest when the Democrat was in office, you missed the 90s under Clinton, you missed the 2010s under Obama. If you didn't invest when a Republican was in office, you missed the 80s during, you miss those times. It significantly impacts your portfolio.
Vote your conscience, stay in the market the whole time.
Exactly.
Brian Levitt, thanks so much for coming by. Good luck to the Rangers.
Good luck to the Rangers. Thank you.
Up next, what to expect from Berkshire Hathaway's annual meeting as big questions loom over the future of Warren Buffett's company. We'll be right back. It's known as Woodstock for Capitalists, hosted by the Oracle of Omaha. Jack, do I have any other business cliches left?
No,
I'm out. Okay. Warren Buffett will be center stage next weekend at the annual meeting, and it's the first time his friend and business partner Charlie Munger won't be at his side. Investors are watching to see how the succession at Berkshire might play out when the 93-year-old is no longer running the company. It's the Barron's cover story this week, written by our resident Buffettologist, Andrew Barry. So, Andrew, this is like your Super Bowl. You will be watching very carefully. What are you looking for at the annual meeting?
Well, you know, Buffett is turning 94 in August, so people will be looking to see how he looks, how he sounds. Is he as sharp as he was last year when he was on top of all things Berkshire and the economy and financial markets? It's a marathon. He'll be talking for 5 hours, which he could test the stamina of a much younger man. He doesn't screen the questions, and he wants tough questions from the shareholders.
So he's been at the helm for 58 years, far longer than any other CEO in the S&P 500. One of these days, he won't be there. What's the succession plan?
Well, I mean, he'll have his successor up on the dais with him, his likely successor, Greg Abel, who's 61. Also up there will be Ajit Jain, who's an insurance maven who heads the insurance businesses at Berkshire. Other people who will be part of the succession plan include his son Howard, who's not well known, who's 69. He'll probably be the non-executive chairman in the post-Buffett era. Then you have the two stock pickers, Todd Combs and Ted Wexler, who now run about 10% of Berkshire's $360 billion equity portfolio. They could run the entire portfolio when Buffett is gone.
So one question is hanging over Berkshire really is, will that portfolio remain intact? Will Berkshire get broken up? What do you think would be the right thing to do, and what do you think will happen?
Well, Berkshire is an anomaly. It's a gigantic conglomerate, a time when conglomerates are out of favor on Wall Street. GE just broke up. United Technologies has broken up. Big companies like J&J and Pfizer have shed divisions. Buffett wants to keep it together. He thinks there's a benefit to being a giant company, given the earnings power the company has and some other tax benefits. But there could be pressure on the company to break up from activist investors or others in the post-Buffett era.
How has Warren Buffett how's his personal brand stayed so strong over the years? He's performed in line with the market for decades. He's around 15 years older than two guys running for president. We talk about them as being way too old for the job. My math says that he's somewhere between Dolly Parton and Jesus in terms of popularity. I'm trying to be more popular, make some friends. Maybe how does he do it?
Well, you know, he's done it in kind of his unique way. I mean, he's basically, he said that, you know, it takes 20 years to build a reputation and 5 minutes to lose it. He's built his over 60 years. Integrity, and just building this business steadily over that period of time to where it's earning $40 billion now this year. And I think he's done it the right way.
Now, Andrew, you've been looking at Berkshire for such a long time and over a long time horizon, but is it a buy today? Do you still think it's a good play for investors?
Well, the stock is trading, I think, pretty reasonably. The A share is around $600,000. The share is about 1.5 times book value, which is slightly above the 5-year average. And it's trading for about 22 or 21 times this year's earnings. But given the defensive characteristics and given the growth characteristics and the fact that you could see reasonable growth in book value over time, I think the stock is pretty reasonably priced here.
I love those images of him throwing the newspapers. He was a newspaper delivery boy, I guess, around World War II. One thing about that portfolio is it's almost really more like a mutual fund than a stock. How should investors think about it?
Well, some people think of Berkshire itself as almost like a mutual fund. Given its broad exposure to the U.S. economy, you're getting one of the greatest investors of all time running your money. He earns just $100,000 a year. It's effectively almost a low-fee mutual fund. And there could be a kicker if there's ever a breakup, because many people think that the sum of the parts, meaning the value of the businesses inside Berkshire, including Burlington Northern, big utility business, a huge insurance operation, are worth more than where the stock is currently trading.
Critique that portfolio. I want to hear about Berkshire Berryway. Tell me, what are like your two favorites that the company owns, and maybe two you'd get rid of?
Well, basically, it's got some of the biggest holdings are Apple, American Express, Bank of America, Chevron. I'm partial to Chevron. I like the energy industry right now. Amex has had a big run, and it's up about 30-40% this year, and it's a little bit rich. I might avoid that one. And I'd say Apple's looking interesting here. It's been a big laggard among the big tech stocks. And it's trading for about 25 times this year's earnings. You get any good news on AI, and Apple could do better this year.
What about that Geico Insurance? Is that Gecko still pulling his weight? I see an emu on the TV. I see all kinds of competition.
Well, that's actually an interesting issue. Geico, it used to be number 2 in the industry, has lost ground to Progressive. It's underinvested in technology. And Todd Combs, who runs the part of the equity portfolio, has been heading Geico and trying to turn it around. It's been a heavy lift. They've been losing market share pretty steadily to Progressive.
They need a new animal.
Yeah.
Alrighty. Thanks, Andrew. Yeah. Great to have your insights. Andrew and Megan also have a pair of investment picks, and Jack is foregoing his usual financial nudism to share an exotic idea. Stay right there. Jack, one of the hottest things with institutional investors and high net worth investors right now is the private credit market. It's now trickling down to the rest of us, and you've written a funny column about it, actually.
Well, investors are piling in. The private credit, these are high yield loans. They're made to risky businesses, and the fees are high. The pricing is opaque. The IMF just published a report on private credit. They use the terms vulnerabilities and limited oversight in the subtitle of the report, so they're not crazy about it. If you're looking at private credit, consider collateralized loan obligations. Don't make faces, Andrew. The name is ugly. It's like if irritable bowel syndrome were an asset class, I grant you. But the head of B of A's research committee says that CLOs offer better risk control, more transparent pricing, and lower fees than private credit. AAA CLOs have never had a default. There's an ETF for them that yields 6.7%. The yield, write this down, Andrew, it's JAAA. JA is the ticker.
And what if you want lower quality credit?
Well, there's a JBBB. I don't know how to pronounce that.
That's what I was hoping for. I'm trying to get that out of you, yeah. All righty. Andrew, you think there is money to be made by taking travelers cruising down the Rhine or the Danube. Tell us about that.
Well, Viking Cruises, which is the leader in high-end European riverboat cruising, is due to go public in the coming week, and I think it could be smooth sailing for that deal. The company is probably best known for some of its ads on Masterpiece Theater that tout the refined cultural experience and fun you can have on their riverboat cruises. They have about a 50% market share in the European market, and it's coming to market this week around $25 a share. The deal will value the company at around $10 billion. It's about $1 billion offering, and it sounds like it could be a winner. It's trading for about 10 times free cash flow, which looks pretty reasonable considering the growth prospects and the nice niche that it has.
And obviously travel seems to be constantly increasing. That post-COVID, a lot of people want to get somewhere fun.
Their boats, they don't allow kids on the boats, no one under 18, no casinos, and so they're trying to make it It's not family friendly, but it's mostly for older people. They target the 55 and older market.
And they screen Masterpiece Theater probably at night.
Right.
Megan, you found an interesting investment closer to home.
I really am. I'm talking Timken this week. So actually, our colleague Teresa picked it. It's still an attractive buy. You might not have heard of this company, but they're very much in the bearings market, which of course is in pretty much every type of machinery you can imagine. Now, it's not something that's going to knock your socks off, but it's more of a defensive play that arguably shouldn't keep you up at night.
Alrighty, thanks very much, Megan and Andrew and Jack, CLOs. Alrighty, to read more, check out this week's edition at barrons.com. And that's all for us. We'll see you next week on Barron's Roundtable.